Everyone. Good afternoon. We are so excited to have you for another webinar in our series. We at Kennedy Financial Group, one of our core values is to make the complex simple, and that is why we are so proud to present My Brain Made Me Do It, which is a look at behavioral finance and strategies for better decision making. Before we get started, I wanted to just go over a couple of housekeeping rules. We wanted to say that if you would like to ask questions throughout the webinar, you can text us at 248-528-0485, and we will moderate the questions that way. So you can go ahead and text the questions to that number. And also, I also wanted to mention that if you want to watch any of our previous webinars, you can do that at kennedyfg.com. All of our previous webinars are up there. But now that we've discussed that, let's get started. Just some disclosures that we have to go over really quickly. If you have any questions about those, you can contact us. I want to take a second and introduce our speakers today. If you are familiar with Kennedy Financial Group, then you are very familiar with the speakers. We've got Brandon Kennedy, who is the president and a wealth advisor here at Kennedy Financial Group, as well as Stephen Fronrath, who is a wealth advisor. Hi guys, how are you doing?
Doing all right. Ready to talk about, I blame this a lot, but my brain did it. It wasn't
Yeah.
excited
The
to
best
talk
excuse in the book.
Yeah. Yes. So for those who aren't familiar with Kennedy Financial Group, just to give you a little bit of background, Brandon, again, is the president and wealth advisor of Kennedy Financial Group. He started Kennedy Financial Group in 2008 and has grown from a practice with just him to a team of 6 that serves over 400 households in the Metro Detroit area and kind of all across the country now. At this point, we've got clients all over the place. So doing whatever we can to help families live their best financial lives. And Stephen, who joined Kennedy Financial Group in 2018 as a wealth advisor. Did I miss anything, guys, that you want them to know?
No, I think that's good. I think yeah.
Perfect. Well, today we are going to get into who is Kennedy Financial Group, give a little bit more of a introduction into who we are as a firm, as well as going over, like I said, behavioral finance, which is a look at why we make the decisions that we make and maybe some of the not so great motivators that influence our decision making, as well as some tips on how we can make better decisions with more sound reasoning, especially when it comes to our finances. So with that, you guys, I will let you take it away.
All right. Thanks, Lauren. Yeah, I just kind of zoom through here. Our firm as a whole, 50 years of combined investment experience. Bob's the other advisor, not on the call today. We're proud to be a Dave Ramsey SmartBuster Pro, and that connection with the folks at Dave Ramsey have changed my own personal life. Stephen's been a big part of that, and a lot of our clients have come from that program and really live out those philosophies of being intentional about your money, living below your means, paying off debt, and just being good stewards of the money that we have. And really, that's why we exist as a firm. We work with our clients to help and really inspire them to live their best and most fulfilling financial life. And that means something different to every household that we work with. And it could be they want to provide for their kids' education or retire comfortably, maybe pass on and create a legacy for kids and grandkids. Whatever you define as winning with your money, that's what we're going to help you do. And that's, like I said, that's our why. That's what gets us excited in the morning to do this and to really chat with our clients and get a deep understanding of who they are. How we help them do that is through our mission, which is to guide people on their financial journey with a clear process to help them achieve what's most important to them. And we really lean into that role as a guide. And, we don't have any set agenda of a product that we sell. We're independent, and we really talk with our clients, get to know them, and walk side by side with them on their journey. My kids and I got into over COVID. Like there was nothing else to do. So we binge watched a lot of things. One of them that we watched was on Discovery called Everest Beyond the Limit. I get that confused with the Disney ride. And it was just really cool to see people, this is a 70-day trek to the top of Mount Everest, and they don't do it alone. There's a team, there's a guide at base camp, there's the Sherpas who are right there with them, and it's done with a team process to get there, not only on the way up, but on the way down. And we really live that out as a guide. It's taking, next steps, and our process is exactly that, right? It's a 3-step guided wealth process. We start it by discovering, getting to know you, what's on your mind, what's important to you, what's your experience with money, what are some of your goals, and help you prioritize that. And that leads us into our next part of it, acting as a guide, giving you a clear next step action plan on what we should be working on. And the most important part of that is engage. That's ongoing discussions, doing some check-ins, doing some surveys on where you're at, getting a pulse on how you're feeling, and then looking at a changing market landscape, a different economy, different administrations, different tax laws, navigating all of those changes and making course corrections to make sure that we are moving towards that beacon that you said was important to you, and making sure we're taking the best steps to help you get there. That's what we're really just passionate about. Got an awesome team. Lauren talked about that a little bit. Bob's not on the call today. He's a partner and managing partner, the other wealth advisor on the team, along with Stephen, who's here. Stephen is a wealth advisor and also heads up our financial wellness. So he's going to speak a little bit today, and he does a lot of other education and communication throughout the year to our 401k participants on the plans that we're on, and just the clients, that we work with. Nicole and Lauren kind of head up the support staff right now. Nicole on operations, making sure accounts are opened and in good order and good compliance. And Lauren just making sure everything is from a client experience standpoint, that we serve our clients as best we can. So super excited to work with this team, and just grateful to serve the clients that we work with. Last thing I'll kind of share about Kennedy Financial is our core values. We all live these out day in and day out. We don't compromise on them. They are listen intently. That goes back to that discovery process. Try to make the complex simple. We're going to talk about some fun things today that hopefully take what causes a complex world of investing to be really confusing, and hopefully simplify that a little bit. Act with purpose, have a servant's heart, and certainly live generously in everything that we do, not only with our resources, but with our time. So I'm going to turn it over to Stephen. He's going to get us kicked started on the main goal and topic of today. My brain made me do it. So Stephen, take us away.
Awesome. Thank you, Brandon. So yeah, today the main discussion that we have is, my brain made me do it. And really digging into this today, our brain, whether we know it or not, makes thousands and thousands of decisions every day for us, from the moment that we wake up to the moment that we go to bed. So that affects what we eat, the order that we get ready in the morning, what we choose for lunch and dinner, what route that we take to work, everything in between. So not only in our daily lives does the decisions that our brain makes unconsciously and consciously affect what we do, but also in personal finance and investing. So today we're going to take a look at really how our brain makes those decisions, try and understand that process, and start to learn how, again, we make those decisions so that we can avoid some of the most common mistakes that we can make, not any fault of our own, but just because we are hardwired as humans to make certain decisions that unfortunately set us up for some negative stuff in the future. But there's some ways that we can help alleviate that and make sure that we can win with our money overall. So before we dig into it, though, there's a couple of things that I want to go with. And, this works better when we can all congregate in a room, but I guess I will talk to everybody virtually here. But in investing, there's an age-old adage of we want to buy blank and sell blank. And hopefully everybody knows this, but, we want to buy low and sell high. And that is one of the most agreed upon investing principles out there. Yet for a lot of us, it's very unnatural, right? When the markets are down, there's a tendency to kind of panic and go, oh my gosh, I need to sell. I need to get out of this. I need to sell when it's low. And we don't want to do that. But for most times, it's not any fault of our own, but it's because our brain is hardwired to make these decisions for us. And it comes down into the fact of if we look at the brain and the decisions that we can make, there's two main types of decisions that our brain makes every single day. That's intuitive decisions and reflexive decisions. So intuitive decisions, these are the decisions that you just kind of know. You've got that gut feeling. Those are typically the decisions that you can make quick in a moment's time, in an instant decision. And reflexive decisions, those are decisions that typically take a little bit more time, that we use facts and data to make those decisions and to decide for us. Now, if we think about investing, us as investors, what do we tend to commonly make decisions the most by? Is it intuitive or is it reflexive? And for the most part, it's those intuitive decisions. We feel that the market is down, we need to do something, or we act on emotion. And especially if we look back to the last year with the COVID craziness and a contentious election year, there was a lot of decisions that we all made because of emotion, and some things were driven by fear or excitement. And those are the decisions that we are hardwired to make rather than the reflexive decisions that we take time to think about. So really, our brain is hardwired to want quick and easy decisions. Now, when it comes to your life savings that we're talking about here, we probably don't want to make quick and easy decisions on those if we can help it. And so to fight that natural tendency that our brain has to want to make those quick, easy decisions, we need to take a new mindset and a new approach to help overcome that. So again, that we can win with our money and set ourselves up to be in the best spot possible for the future. So I'll turn it over to Brandon here to start talking through some of the most common investing mistakes that our brains are hardwired to do and some of the ways that we can alleviate those and look out for those.
All right. Thanks, Stephen. Way to cue it up. And yeah, we're going to get into 6 main areas. Before we do that, do we have a poll ready? Do we have that? So
yep.
We do this poll from time to time on these webinars, and it's nice to, we work hand in hand with clients, so we have a general pulse of where people are feeling, but we're going to throw it out there on where do you think the market will end at the end of the year for 2021, up 10% or more, flat, no real growth, or down 10% or more, which we mean we'd have a pretty big correction from where we're at. So if you guys can chime in, throw that in. We actually did this exact same question and survey a year ago in 2020 during what was a shutdown, which was in a scary time. Markets were pretty ugly still at the time. And yeah, as the results kind of come in, looks like we're kind of split on all of these. We'll let them come in a little bit more, but all right. So it's kind of a mixed bag, right? And that's exactly what it was last year. It was half people thought it might be up, half the people thought it might be down, and it just goes to show that was last year when we were in a global pandemic and a recession, a forced shutdown recession. People kind of had the same thoughts. Now we have a new administration that's in place. We sort of have some clarity on where we're at. There's still fear and uncertainty, and that's for a variety of reasons. And we're going to tackle some of these. So we're going to go into 6 main, investing mistakes that people make for these different reasons that our brain is pulling us maybe in the wrong direction. It's loss aversion, anchoring, status quo, procrastination, hindsight, and availability. So we're going to jump into each of these. And what you'll find is some of you may have a tendency to do the same type. You may have loss aversion all the time, or maybe in different seasons of life based on what's going on, or just based on what your family dynamic is at the time. You may run into these. So we're going to cover them all. They may or may not apply now, but they're good knowledge to have of what may play out later. First one that we're going to talk through is loss aversion. And this is, we have a general tendency to focus on and be more impacted by loss or negativity than a gain or things that are positive in our lives. And we see that in a variety of ways, not just in investing. If we look at the sports analogies, right? When biographers go and interview athletes who have had incredible success, and they get into some of their disappointments, right? Most people have had, even if you've won championships, you may have had a loss, right? And they can describe in much more detail, and way more emotion comes about from the disappointment or the loss than it does from the win. And these are incredibly successful people in life, but that loss sits with them. And there's a reason that it does. And again, I get to play neurologist a little bit today, in my free time. We've studied this a lot, behavioral finance, because it does impact investors' decisions. And there's two parts of your brain. One's called the neocortex, and one is kind of referred to as the crocodile brain, right? It's your old, primitive, fight or flight type response from that part of your brain. Neocortex is what we as humans, why we're differentiated, right? We can analyze complex things, we can process data, we can make very complex decisions, but the crocodile brain is what causes us to drive a lot of our emotional decisions. And the reason it's there is that fight or flight, right? It was so we didn't get eaten by a predator, right? We had to make these decisions, and we learned from that negativity or that negative outcome, and that sticks with us more. So it very much is driven by the biology of our brain, that negativity or loss sticks with us and impacts us more. Now, how does that play into investments? You may have said to yourself at one time or another, I can't sell now, it's down too far, it'll come back eventually. Or we hear this one a lot, I don't mind staying in cash, markets are crazy, I'd rather be safe. And that feels safe in the very short term. I don't see my account fluctuate as much. But that can be devastating, especially in the environment we're in right now with rising inflation. Sitting too much in cash for any period of time, we're going to see, I don't know if anybody's bought a 2x4 lately, but they're $10. Inflation is going to be real. And if we don't have a plan to combat that, and we just say, I can't avoid loss, our purchasing power is going to be eaten away over time. One of the best ways to handle that, so this is kind of how we're going to go. We're going to talk about each one and then talk about a remedy. How do we remedy that loss aversion? And I'm going to just highlight the most important. Here's a couple of different ways that you can do it. But the most important of these for me is, don't just be prepared, right? It's easy to say, yeah, I know my portfolio is going to fluctuate, but we got a little bit of technical glitch. I think we're back on. All right. Expect volatility. The general rule of thumb, if you are an equity investor, you will experience a 15% decline every single year, even in good years. And all that is we hit a new high and pull off of that high, and there's a downturn from that. Expect that. Embrace that. And if anything, be prepared. And we do this as a part of our process to rebalance and buy more, right? Going back to what Steven said, buy low. When things are down, great companies that we own are on sale. We should be buying those, even when it is uncomfortable and doesn't feel good to buy those. So that's loss aversion. Steven, I'm going to turn it over to you on anchoring.
Yeah. So anchoring, another tendency that our brain has to make these decisions. And really anchoring just comes down to is finding one piece of information and your brain just latching onto it, maybe too heavily, or weighing that piece of information greater than others that you may have. So this one, I think it's easier to explain in an example. But if we look at this next chart here, if we look at this in context, this is the market crash of 74. Now, if we look at it in context here, in 1974, I wasn't alive in 1974. If you can't figure that, but if we look at this here, at the end of 72, the S&P 500 was at 14,000. In 1974, that went from 14,000 down to about 8,000. So in the moment, that felt like the end of the world. Now, this could have been the burst of the tech bubble. This could have been 2008. This could have been 2020, last year, where in the moment, it feels like the absolute end of the world. That how could we ever get back to that high that we were once at? It's really hard to see the light at the end of the tunnel. But hindsight always gives us the ability to go back and look of where was that in context. So if we zoom out between 1974 and now, you can't even see the downturn there. It truly was a blip on the radar. And we can look at that from there's the tech bubble, again, early 2000s, there's 2008. In the moment, those feel like end of the world crises that will never resolve themselves in the moment. Just like if we throw ourselves all back to March of last year, there was no hope of a recovery, there was no hope of a vaccine. And look at where we're at just 14 months later. And it just goes to show you that if we take one piece of information and focus on it too heavily of in the moment, it can really affect us here. So again, some warning signs for that. Again, like we've talked about here, 6 months ago, I had 100 grand inside my IRA. Now I've got 80 grand. I just need to get back to that 100 grand there. And relying on that too heavily can be the downfall of our long-term investing strategy. So honestly, for me, I think the most important way to remedy this decision that our brain inherently tries to make is to seek out some information to give you perspective and peace of mind. And this is one of the things that we did in the midst of COVID craziness last year as we started a thing called Facts Over Fear. And this is really going back into these couple of graphs here. In the moment, this feels like the end of the world. But zooming out and looking back at history of there's always a crisis. There's always something that's going to end the world every single decade. And going back at time and looking to see that it wasn't the end of the world. We came to a resolution, we moved forward, and in the grand scheme of things, it didn't really matter as far as our long-term investing goes. So that's one of the best ways to remedy that on the anchoring side. The next one is status quo. Brandon, I'll let you take that one from here.
All right, so status quo. We run into this a lot. We meet with a lot of new people who are just maybe getting started with their investing or looking at a second opinion on what they're doing currently. And status quo is they have to fight themselves on that. It's much easier in the moment to do nothing, to just say I'm going to leave it alone. We're creatures of routine is very much true, and it's easier just to leave it be and not make a decision. There's a great quote. It's a tricky one, so I got to read it, but it's from Ben Feldman, who was a longtime insurance person. But the quote is, doing something costs something. Doing nothing costs something. And quite often, doing nothing costs a lot more. And it gets back to the same thought of a no decision or no action is a decision. And oftentimes that can be catastrophic in what a portfolio or an investment plan, what that can do. Some of the things that we may run into or see ourselves saying is, I've had this investment for a long time. It's worked pretty well. I'm just going to leave it alone, whether that's an old 401k or a fund that you've had for a period of time. Another one, maybe, half my portfolio is my company stock. I've heard that's not such a good idea. But I don't know what else to do, so I'm just going to let it ride, right? That should not be your long-term investment strategy. Let it ride, or let me just leave it alone, and I think it'll be okay. Having a plan and process is where we need to be. Another one that I see often is I'm going to just stay in cash for now. At least I won't lose money, and I'll figure it out later. Again, on the inflation thing, that is going to be a strategy that is not going to work well. Another one that came to mind when I was going through status quo is Dave Ramsey we talked about, right? Normal is I have car payments, I have debt, I live paycheck to paycheck. Normal is broke. So that status quo of, well, everybody else has car payments and everybody else has a big mortgage, so what's the big deal? I guess it's not, but if you want to change your financial future, if you want to change your family tree, create a legacy, you have to take some action and do something different in most cases. So how do we combat that or remedy that? For me, the biggest one is, make a schedule, make a plan, and revisit that often. So make a decision, create a plan that aligns with your goals. Certainly that, part of our process, right, is discover, guide, engage. That's exactly what we're doing. We're putting together a plan based on what we know, but we are revisiting and talking through it, not making emotional decisions, but just checking in. Is that the right plan? Do we need to make a course correction? That is okay to do, but just saying I'm going to leave it alone because that's what I had in place. One of the things as a business, right, we go through these things, and we just have somebody that we brought on, and I told her, if we ever say, the reason we do that is because that's just the way we've always done it, call us out on that. That is not okay. And it shouldn't be for your financial plan. If that's what you've always done, but it's not the best plan in the moment, then be open to making some change. So that's status quo. Stephen, procrastinate. I actually wanted this one because I'm pretty good at procrastinating.
I don't think we need to do it now. I think we can do it later.
Yeah, we are all wired this. So this is an easy one, and I think we can all relate in some way, but we'll let Stephen talk about procrastination.
Yeah, I think as Brandon said, I think this one probably requires, I think, the least explanation out of all of these, because I think we all can relate to this, whether yesterday, today, this hour, the past couple minutes. I think we've all procrastinated something in our lives, and that, I think, it's one of the most dangerous things that we can do in our personal finance or investing. I mean, think of, we've talked to, I can't even tell you how many people over the years that they wanted to start a college savings plan for their newborn baby. And that newborn baby was just born yesterday, but somehow today they're 10 years old and they still don't have the college savings plan set up. So telling ourselves, we would love to do this. I told myself 6 months ago that I'm going to work out, get in shape. I got my home gym all set up, but have I done that in the last 6 months? Not yet. So maybe I can have Brandon hold me accountable here for that. But same thing goes true on our investing in personal finance. But whether it's starting to set money aside for retirement in the 401k plan or open up an IRA. So these are the common warning signs I think we all can see. So how can we get ahead of that and make sure that we stay on top of that? And I think for me, the biggest thing is involving others to hold yourself accountable for these decisions. So maybe it's a partner, maybe it's a spouse, maybe it's a friend, a family member, but telling somebody, if you're going to start saving money for your kid's college, tell somebody and say, hey, I plan to open up a 529 plan for my newborn son in the next 3 months, and have that person follow up with you and remind you, say, hey, did you open that? Did you talk with an advisor? Did you put money aside? Again, we're not always the best at holding ourselves accountable. So let's utilize the friends and family and resources that we have around us to hold us accountable, to hold us to those decisions, and make sure that we can fight the effects that procrastination can have against our plan.
All right. Hindsight bias, right? The saying hindsight's 2020. Certainly it always is. And investing, this can be a dangerous area that we can, going back and looking at. I remember one of the first things I learned in training was, when you talk about investments or you show, an investment, making sure to give the disclosure, past performance doesn't guarantee future results. And I'm going to share an example of that in a moment. But, this is, I don't identify with the analogy of the bar, closing the barn after the horse ran away. But, it happens, right? We do things after the fact that would have helped us prior. And even professionals do this, right? So you look at the mortgage meltdown in 2008, 2009, and that made it, prior to getting a mortgage, it was not what it is today. Stephen, you bought a house a couple of years ago. It was very different. In 2006 and 2007, you could just say, hey, I make $100,000 a year, and they'd say, okay, here's a loan. Now, the amount that you have, how tight credit was and how stringent that process is because of what happened with that mortgage crisis. And it was a little bit too late. Hindsight, they said, oh yeah, we should have done this. This is what the news law should look like. So we can learn from our mistakes. That's okay. But what we don't want to do is chase performance, chase what has worked in the past and what we assume will continue to work. One of the best examples I can think of, and I share this example often, is the Fidelity Magellan Fund. A really cool story. It's a longtime fund. It was the flagship fund of Fidelity. It was ran by a Hall of Fame investor, Peter Lynch. From 1977 to 1990, Peter Lynch took that fund over and was the portfolio manager, averaged almost a 30% annualized return. It was the best fund in the world, by far, the best performing fund in the world. He grew it from $20 million to $14 billion in that period of time, and was just an incredible fund. I think what's even more interesting than that is what happened from 1990 to 2005. This fund became the largest mutual fund in the world. It had inflows like it never had seen, and it grew to over $50 billion. It tripled in size over that period of time, mostly from inflows, because during that period of time, 1990 to 2005, in its category, it was one of the worst funds. It underperformed the majority of other funds out there. And the reason is Peter Lynch retired in 1989. He had his retirement plan. He was fully off the fund by 1990. So the 15 years that the fund became extremely popular, that more money than ever had flowed into it, was because of the past performance. Most people didn't realize or didn't care to look that Peter Lynch was long gone and retired, and it was a new person that was on the plan on the fund who was not an elite performer. So hindsight was, I'm going to buy this fund with this track record, but what I'm buying is not what it is any longer. And we just can't go through that as our process. You can see this. This is just a quick chart, just kind of looking at fund flows. Very similar story, but this is chasing returns, right? You can see this orange line along there is fund flows, and people pull money out of investments when markets are down. You can see in 2008, 2009, more money was pulled out of equity markets than ever before, when people should have been adding into equity funds, and vice versa, right? When we had a run and a recovery, you see lots of dollars going into stocks. Again, like we talked about, buy low, sell high. We can look at data, and the average investor is doing the exact opposite. They are buying high. They are chasing the returns. This fear of missing out, right? This FOMO that my kids use, and I didn't understand what it was until I had to look it up. I thought it was something bad at first, but it's this fear of missing out, right? That these returns are real and they're happening, and I want to be a part of it, so I'm going to get in now. Not always the best thing to do, right? Look, the Wayne Gretzky quote, right? I skate to where the puck's going, not to where it's at. That's how you want to be a long-term investor. And we see this play out year in and year out. The average investor return is about 3%. The average stock market return about 10%. That disconnect is poor behavior. Not having an investment process behind it. What do we catch ourselves maybe saying? Market's done great this year. I knew I should have invested more. There's chasing the return. I don't care what happens next. I'm moving to cash until things calm down, doing the opposite of what maybe we should be doing, buying more. For me, the best thing that we can possibly do on that front is have a long-term perspective, really have a plan behind us, and make a commitment to think long-term. I thought this was a great idea, and we're actually going to start implementing this with clients, is writing a letter to ourselves or an agreement, right? We work with clients. We talk about what should your long-term plan be invested in. A lot of times that's in growth, equities, because we're trying to outpace inflation, build a legacy, and that's a good place to do it. And everybody agrees in the initial meeting, yeah, I want to grow my money by 10% a year. Why would I not want to do that? And everybody says, I understand markets are going to go down, but when it's real, people make bad decisions. People get emotional. People go through all of these things. I thought this was this was from another financial professional who recommends doing these things. We're actually going to implement it. I'm going to read the letter, and I think it's something that you should consider doing. My financial professional and I have established a long-term plan. Sometime in the future, the market will correct to the point where I feel uncomfortable staying invested. I feel scared, and I may feel scared and ask my professional to get me out of the market. And it's beyond scared. People are terrified. People are thinking this is the end. This time it's different. Um, Going back to the letter, but I know my plan is sound, and if anything, it may be a good time to invest more. My long-term goals haven't changed, and I'm committed to sticking to my long-term plan. Really great thing to sign, to put away, to reference back when it feels like this time it's different, and you might make what is a lifetime mistake that you can't go back and fix. We had one, and I don't like to talk about this, one client out of 400 last year, and it still eats at me, and we still talk it as a team, who sold when markets were down. Just one. Still, I don't like the one, because if they would have hung on, boy, it was a heck of a year performance-wise if you went through and thought long-term. So having something like that to reference back and say, hey, I agreed to this. I understand this. We talked about why I think long-term and why I have to be comfortable with downside. And if you can do that, boy, and it saves you from making that mistake at the wrong time, you're going to thank yourself later. All right. That's the last one, availability. Bring us home.
Yeah. So I think, like everything that we've talked about today, where we can reference back to the last year, the availability bias is real. I mean, really, availability, the danger there is using the information that is front and center. It's the loudest yelling voice in the room. Using that to guide our decisions is something our brain wants to gravitate towards, but we can't let it. If anything in the last year has told us, it's that the loudest voice in the room, whether it's the TV news, whether it's the newspaper, whether it's Facebook, Twitter, just because it's loud and in your face doesn't mean that it's the most important thing or it's even accurate. So, I mean, if we look at, again, the news media last year I think there was an article out there that in April of last year that said the probability of a vaccine being developed over the next year are slim to none, definitely not going to happen. And we look at the news that came out yesterday of over 50% of this country is vaccinated with a vaccine that's out there. And so that just goes to show us that just because something is the loudest thing out there doesn't mean that it's always right. One thing that Brandon mentioned earlier is that the four most dangerous words that we can say is this time is different. And the media always says this time is different. There's this crisis. Oh, we've never experienced this before. We've never seen this before. So one of our favorite examples that we like to touch on is Time magazine. Time has always been great to look back at things that have happened before. And let me just show this here. So we look at some of the Time magazine covers that are out there. Middle East violence, a weak US dollar, gas prices. Maybe these were all magazine covers that happened in the last, Brandon, 3 months that I think we've heard all of these.
Housing bubble, right?
Housing,
a lot of talk on that. China is going to take over the world. Yeah.
Federal deficit. We've got a lot of debt on our hands. How are we going to ever cope with that?
These are things that are real right now. Yep.
Yeah. But these were not magazine covers from 2010 to 2020. These were magazine covers from the 70s and the 80s. And the same issues that were portrayed as end of world, this time is different, have been happening for decades. And it's all about perspective. Brandon, I know you wanted to touch on this a little bit here. We've got another poll that we wanted to put up here of 1980. So, Brandon, I'll let you kind of lead this one here. But the Dow in 1980, where do we think that was at? I think just for hindsight here.
I think this is kind of interesting, right? So the Dow, I don't know if anyone knows or not, it's around 34,000 today. It's the 30 largest companies. And where was it? Now that's 40 years ago, boy. That's a lot of people. I'm watching some of the answers come in as we go, but where do you think it was in 1980? This was, again, new administration. We were a lot of change. Interest rates were now, at an incredible rate. A mortgage was 12%. We got some right answers. So go ahead and chime in if anybody else will give you a second to put them in. But it actually was 824.57.
We got a
So
lot of smart people on this call.
it didn't just double or triple or 10 times what it was. This is an incredible amount of growth over a 40-year period of time. And if you're a long-term investor, your time horizon is very long, right? It's money that you're probably not going to spend. You're going to pass on to your kids and grandkids. So having that long-term perspective, not getting caught up in what's going to happen in 6 months and a year, is going to give you the right mindset to look past these kind of headlines.
Yeah, exactly that. I mean, some of the kind of warning signs to look out for with this is, especially I like the last one here of the guy on TV says gold is the thing to buy right now, or Bitcoin is the best thing to buy right now, or whatever the hot new fad is with that. He's on TV. He must be right. So again, looking at those of the information that's loud in our face is not always the right thing. It's not always the most important thing. Just because something is urgent doesn't mean it's important. And I think that's one of the best things to keep in mind of how to make sure that we stay away from this. And my biggest takeaway from this really is don't always believe everything that you hear. Just because it's on TV or on the internet or on some news site doesn't mean that it's important or that it's real or that it's telling 100% of the truth. And then always take this in mind anytime that, what's the old saying, if it bleeds, it leads. Bad news sells way more than good news. And there's been plenty of studies out there that show increased traffic to websites when you've got negative headlines. And whenever there's a positive headline, you never get the same amount of traffic or same amount of attention. And that's what the goal of these websites are, is they've got advertisements, they got bills to pay. So it's always keep in mind that the negative news always sells more than the positive news. And if we can keep that in mind, that will really help us avoid some of those pitfalls of falling trapped to really the loud information that maybe not is always the most important in the current moment. So Brandon, I'll kind of turn it over to you if you want to kind of summarize. We've kind of talked through a lot over the last 20, 30 minutes or so here. I'll Brandon kind of take over from here.
Yeah, so hopefully this was somewhat, interesting, informative. I always like to understand the science around how our brain works and where we go, and then just be more aware of it. And I think that's the biggest takeaway from all of this is your brain and your emotions and your gut feeling is going to have a real significant driver on the decisions that you might make. So you want to have, we use this term a lot, but those that have a plan and a process for making financial decisions have better outcomes than those that don't. And that's really what you have to have. So there's just to tie it all together, really when we act, as a guide and as a fiduciary on the plans that we're giving to clients, we are that independent third party that can maybe get you away from what you're seeing on TV or what you're hearing, at work or what you're reading online, because the confirmation bias is real. You can find the answer you already kind of think, right? You can find that. So let us be the filter. Let us be the guide, that word fiduciary, right? That we have a legal contract that says we have to recommend what's in your best interest. That is to your benefit. You get one chance to live your best financial life, and having a guide along the way that's on your side to help you get there is vital to be able to make sure you can filter out that stuff. So hopefully this was enjoyable. Lauren, I don't know if we're kind of 45 minutes in, if we have any questions that we want to go through, or if you want to bring us home. Yeah.
Again, if you have questions that you want to ask, it's not too late. You can text us at 248-528-0485. One question that we got is that you mentioned availability being an issue when it comes to the media we consume, but how do you navigate it when the advice is coming from your friends or family?
Well, I guess it depends who your friends or family. I'll keep any specifics out, but I mean, I have a lot of family members who are in the medical field or in other fields, and they think they know a whole lot more than I do. And good for them. That's fine. But where is the information coming from, right? How are they qualified to make those decisions? What filters are they using? A lot of time, I read an article or I heard this. What was the Trump people are saying, right? It can't. That can't be your process. That can't be your process. So, there's good information, through publications and some of it, on TV. But remember, what's on the news, what is breaking news, is meant to sell advertisements, not to give real financial advice. What we do as advisors is give real independent advice. So I would just be really cautious of where that's coming from and what is your filter to make sure that that's not an article that was designed to sell advertisements or to sell a book or anything that was self-serving, that it's really genuine information.
Kind of piggybacking off of that, there are so many experts, in quotes, now giving advice. How do you know who to trust and what is the best way to vet them?
So many. Okay. Yeah. I think stepping back and looking at, and this is for us, what is your plan? What are your goals? It is very hard to give generic advice. And, we give a lot of education, right? But we try to have it be general education that you can take and then have that conversation with an advisor. But every single person is different and has a different circumstance. And that's why that discovery process that we go through is so important, to get a deep understanding of what's the priority, what is that root cause of your problem that's there, and then let's come up with a solution to get you there. And if it's just blanket advice on buy this investment, boy, how can you know if that's relevant to you? So really having an understanding of who you are, how you're wired, and what are your goals is going to have come up with a better solution.
Yeah, awesome. That I think takes care of the questions. Great job, you guys. That was awesome. Especially, I think the availability one really struck a chord with me. I think that's like something that you see a lot now and need to keep in mind, especially like you were saying, Stephen, that bad news is what sells papers and keeps people tuned into the TV. So keeping that in mind, I think is really, really important, especially like tying that into having a long-term focus, especially when it comes to your finances, is really helpful. Really quickly, I just want to, before we close out, kind of give everybody the opportunity to sign up for our June webinar, which we are extremely excited for. We are going to be joined by LPL Financial's Senior Vice President, Chief Market Strategist, Ryan Detrick. And I know that he is like an amazing speaker. He's going to give us some information about the markets and what's going on right now, as well as answer some of the pressing questions that clients have been asking us lately. I know he is kind of a big deal. I think Brandon and I were joking about using that as our advertising strategy. Is Ryan Detrick, he's kind of a big deal. It's just going to be the tagline for this particular webinar. So we really encourage everybody to sign up for that. That'll be June 30th at 2 p.m. Eastern. And we would love to have you all join us for that one. Again, we exist to help people live their best and most fulfilling financial life. So if there's any way that we can help you do that, please reach out to us at 248-528-0485 or email team@kennedyfg.com. We would love to answer any questions that you have. With that, have a fantastic afternoon, everybody.
Thanks, everyone.
Thank you.